Hello, welcome back. Thanks for joining us for another episode. Today, we wanted to talk about something that's highly controversial, especially in my feed on X. In the tech sphere, it's kind of the number one thing people are talking about, and that is this potential billionaires tax in California. So, anyone that is a fan of the All In podcast in the U.S., they've talked about this at length, and some information came out in the last couple of weeks, specifically related to the two founders of Google, who have reportedly removed all trace of their, holding companies, any sort of assets. They've sold up and moved out of California to try and avoid this potential tax. It's not even confirmed yet. And depending on who you ask, there's a lot of people that say it has absolutely no chance of passing, but clearly there's enough of a risk that some pretty significant wealth has left the state. So a bit of background on the actual proposal itself. So this is, it was brought forward by the United Healthcare Workers Union, which is a California-based healthcare services workers union. And essentially what California state law allows is that if you collect enough signatures, or you propose a ballot measure and you collect enough signatures to support that measure, that measure will appear on the next ballot. So essentially the population can vote on it, and if it passes, then the law passes. And so what this union has proposed is essentially what they're calling a billionaire tax. And how it works is it's proposed as a one-time 5% tax on the assets of residents of California net worth above $1 billion. And one interesting tidbit that has come out, especially in the conversation around Google, is the way the act has been drafted. And again, this is still draft legislation, but the way that it has been drafted is if there's a discrepancy between the percentage of ownership and the percentage of control over the company, then the amount will gross up to the amount of control. Now, this is very important, especially for founders such as Sergey Brin and the Google's two founders, is they have unique, essentially a share class that is separate from the public entity shares. And what those shares do, we'll call them, let's say, Class B. What those Class B shares entail is 10 times the voting rights for every one share of voting stock. So typically, common shareholders or preferred shareholders would get one vote for every one share. Those two founders get 10 times the voting shares, which allows them, if you gross up their percentage of ownership, they have over 50% of the outstanding voting shares of the company. So although they don't own 50% of the equity, they have effective control over the voting of the company, which is important. Another example is Zuckerberg at Meta. So I don't know exactly what the multiplier was, but I believe it was at least 10x. So again, he did that specifically because he wanted to control, despite selling stock and despite being a minority shareholder, he still has the voting control over the business. Now, what this act would essentially do, which is partially the risk, especially for the Google founders, is they would treat the voting stock as if it were ownership stock. And so let's say they have 10% of shares in the company, 10% ownership, because 3%, let's say. If you have 3% and it's worth 10 votes per, that would be multiplied by 10. So they would be taxed according to 30% of the entity value of that business. So essentially this would be tens of billions of dollars in tax owing by these two individuals, even though, first of all, this is not liquid assets. So these are old, privately held shares from when they founded the company. These have not traded hands. They've never purchased these shares. And secondly, in order to actually pay the tax bill, you would have to do two things. First of all, it would again be this grossed up tax amount that would be far in excess of what you actually own in equity, because it's based on the voting shares, and they would have to sell the equivalent number of shares to be able to pay that. And now, two things. First of all, when you sell stock, you also incur a capital gain tax. So they're paying a capital gain tax when they're selling any stock. And secondly, they would have to sell over and above the amount of stock that they own, or this 5%, they would have to sell essentially 50% of their stock in order to pay this potential tax bill. Now, people will say, "Oh, well, you can pay it over 5 years and blah blah blah." But in any case, it's a huge tax bill. So that little discovery in December, and the reality that a lot of people are becoming far more outspoken about whether they're actually leaving, has created a lot of discussion around, does this thing actually have a chance at passing? So they need, in order for it to pass, and I would definitely direct anyone else that wants to hear more about it. Again, the All In guys have done a lot of discussion around it. There's a lot of good articles from people like YC in California about, the impact on founders. But essentially, as long as this ballot initiative gains 900,000 valid California voter signatures, it will appear on the ballot. Now, the next question is, will the public, 50% plus one vote, agree to this measure? Now, personally, I think that it has a very good chance of both collecting signatures and passing. And the reason is that it's very, very easy to explain this away as, the 200 to 250 people in California that have over $1 billion. Why do they care about 5%? And controversially, there have been certain people like Jensen Huang, the CEO of NVIDIA, who have actually come out and said he would be happy to pay it because his wealth has been created in the state of California and a bunch of other personal reasons. So it's not a clear cut, this is bad, this is bad for the state. The public should unite and get behind avoiding or voting against this measure. I think there's a very, very strong chance that enough of this population in California will look at that and say, it's trivial for these billionaires. It's going to help us pay for healthcare. There's so many other downstream positive effects to the society and to the population. We should do this. And so as a result, I think, unsurprisingly, there's been a lot of anecdotal evidence that huge swaths of the state of California, in terms of billionaires and wealth, have been leaving, have been essentially selling their assets. They've been taking their holding companies and incorporating or domiciling elsewhere, whether that be in the US or offshore. They're taking their businesses. So there was an example of somebody that was employed by a business and the founding ownership family. And the family uprooted everything, moved to Colorado, and this individual was out of a job because they essentially said, unless you're willing to move with us to Colorado, we're not gonna. There's nothing here for us in the state, and that's a big hard line in the sand. Is that they need to make sure that they have zero ties to the state. So for those that are serious about it, they're making sure that it's a very, very clear, firm break from the state of California. So that's the backstory. There's also some speculation around, like, if it chases all the billionaires away, are they just going to lower the barrier to entry to anybody that has over 100 million, anybody that has over 10 million? And will this essentially become like every other, asset-based tax? Rather than a one-time, let's top up the budget initiative, this is going to be sort of like a long-term, requirement for staying in the state of California. And it's also somewhat ironic because despite all of this negative feedback from arguably the group of technology and the group that is most impacted, the representatives, the politicians, people like Ro Khanna, who's one of the big proponents of it, have doubled down and said this isn't a concern. If they want to leave, they can leave. This isn't a big deal to us. And that's just also raising alarm bells, because it's like, if you guys, Dave Freeberg, one of the guys from All In, posted about it. If these assets leave, your tax base erodes significantly. The top 0.1% of wealth in the state provides over 50% of the budget. So if you're losing $2.5 trillion of assets, you've lost, let's say, $10 to $20 billion of annual revenue to the budget. So anyways, it's a pretty seismic change going on in California. And before we sort of get into ways that we can kind of learn from it and potentially the impacts of people here in Canada, or maybe copycats, like if there's going to be someone, let's say in the NDP, that sees this and says, hey, let's try and do the same thing to Canada. What are your initial thoughts, and what's sort of the main takeaway if you were in California, you had started a business in California? Why don't you start, Mike?
Well, hearing this off the cuff, it sounds ridiculous. Like it sounds like a way to push out. If you're telling me the majority of the revenue, the tax revenue is coming from the billionaires in California, and this is gonna hit them where it hurts, their pocketbooks. This is just a way to drive that revenue away. So it seems counterintuitive. However, we have to, I guess we have to empathize. California, like I was looking at the statistics you shared, they're running a massive deficit. So I'm not saying that this is going to solve that, but they do need to come up with creative solutions to solve that. They got a 20 to 30 billion dollar annual deficit based on what the stats you sent, a 1 trillion pension liability for public employees and unions, and 500 billion dollars of outstanding debt. So obviously, it's this is a great opportunity to draw some parallels to Canada because we're running at a massive deficit as well. So I guess they're at a point where they're trying to get creative and trying to find ways to generate revenue for the state. I don't know if this is the right way to do it. Here we're all entrepreneurs, so obviously we're business owners. We always want to find, we want to maximize uh, growth and prosperity for all. So how can the government and businesses work together to drive more revenue to the state, more growth, and both prosper? Not where it's like, okay, you know what, you rob Peter to pay Paul. I'm not in the policy making position, so it's tough for me to comment on that. But to me, from my initial thought, hearing that, and I'm surprised that Jensen was. So Jensen said he was okay with paying that. That's pretty
Allegedly, yeah. So what's been
allegedly.
circulating online? So take it with a grain of salt, whether or not he believes that
I
deep
think they
down.
can
But
get more creative and come up with different ways to kind of address this deficit. I don't know how. I would have to brainstorm on that. What do you think, Andrew? You think this is the way
Well,
to address that deficit? That
well, like hearing about this, essentially, it's going to drive out a lot of billionaires and a lot of wealthy individuals. So this is a tax on wealth, right? This is essentially what it is, right? And in my opinion, I think it's essentially it's a signal. This is sending a signal to not only the billionaire founders, right, but people, future founders, future investors, future executives, on how they're welcome long term in these in the state of California. This essentially sends a signal saying, hey, you know what? How can you be confident in scaling the business, growing the business, and growing it to the scale that it is, and help generate all these jobs, this wealth, and essentially paying taxes. Everybody pays taxes. There's corporate taxes in there as well, right? So they're creating an economy for the state, and I think what the signal here is that is not stable, right? Like, if something like this all of a sudden passes, this sends a signal to all future founders and investors that California is not the place to be because it is not stable. I cannot grow a business here. I cannot, I'm not incentivized to grow a business to be billions of dollars like it used to be, right? Like maybe this is not a place to do it. Maybe Texas is the place to do it, right? So
let,
it's
let's play
essentially.
devil's advocate, Andrew. Say you started your business, and I'm just going to play devil's advocate. You grew up a massive business in California. Your heart is in California. You love it there. You're attached to the culture, the people, the landscape. Your success has come from there. You have thousands of employees in that state. Now, would you look at this like, hey, this is an opportunity for me to give back and to help, my state that I love, or to help the people that this will help people that are my employees? Or is this like, hey, you're attacking me? I'm out of here. I'm leaving. That's the thing. Like, I don't know. Like, we're not in that.
Well,
How
let
would you
me
look at that?
let me tell you this. Like, it depends on how you look at it, right? Like a lot of these billionaires and very wealthy individuals, they have their money ties up in the market, right? They have options, they can leave, but they decide to stay in a specific state. Now, if and I'm going to ask you this question: is the money that's sitting in say my business, say I'm Elon Musk or whatever, the money sitting in my business in Tesla is generating value, is employing people, hiring engineers, creating value for people, for company. Now, if I take a part of that, okay, of my own personal wealth, my own incentive to drive this company forward, I give that to you, the government, right? Can I trust you to perform the same way at the same level that I'm going to perform in my business? Can you generate the same amount of value, jobs, job creation? Can you do the same thing to that level? Probably not. I can probably say that, the government is probably a very inefficient business. So, in my opinion, the money staying with these individuals or being held into these large companies are actually creating value for society, right? Like creating jobs. Just a matter of making sure that they're reinvesting that money, that wealth back into the company and growing it further.
So there
That's
you go.
take on it.
There you go. Let's spin off that. I like that answer, Andrew. Great. Kyle, Andrew mentioned reinvesting back into the economy. What do you think about that? Is that an opportunity?
Yeah, so let me,
They're
I
already
guess, play devil's
investing, but
advocate,
yeah,
because
go
I
ahead.
think that's sort of the standard response, or the MO, is to say, you want that sort of, we'll call it trickle down economics. Like the richer you get at the top, the more you spend, the more you employ, the more you invest, all that kind of stuff. And I think generally speaking, it does apply. I think the exception to that rule is this sort of example where you've got a couple people that have a huge amount of paper wealth. Now, one thing that's also forgotten in this conversation is, once you hit a certain level of wealth, so let's say you have $1 billion in stock, you found, like using Andrew as this founder example. So Andrew goes and founds a company in California. He grows his company to $1 billion. Now, his wealth is going to be tied up. He's a paper billionaire, but he's not a liquid billionaire, meaning he doesn't have $1 billion in cash sitting in the bank. He's got $1 billion worth of the value of the stock, the shares that he owns, that he grew the value of because of this company that he's built. Now, the amount that he would invest and put into his company is going to be limited by the operations of that company. Just because the company is worth a ton doesn't mean that they're going to hire 1 million people and they're going to pay each of those employees $1 million. Like, there's a lot of different factors that goes into it. It's not just the top line value. The other thing that is lost in this conversation a lot is that people look at the billionaire class and they say they don't pay tax, because in reality, the nominal tax is much, much lower than, the typical, wage earner. And part of the reason is that the billionaire, asset class is able to borrow against the asset. Now, what happens when you borrow against your stock? First of all, it's not taxable because it's debt. And secondly, you're not required to sell the stock. It's borrowed as an asset while it's actually still paper wealth. So you're not required to sell it in order to leverage it like we would with most income. So if we're getting a paycheck, we have to get paid and pay the income tax on it before we can put it in the bank and leverage it as an asset. So in this case, they don't pay the capital gains. This is old stock that's been sitting in there for 20 years, and they're able to borrow against it and live off that debt and then just service the debt essentially tax-free, right? And the only tax that they would end up paying is, capital gains for the stuff that they're selling, or asset taxes. So if they're, trading, flipping houses or assets, or again, acquiring, consumption taxes like VAT or GST or wherever. And so again, to play devil's advocate, there is a very clear distinction between the majority of the population, and there's this very, very small, 0.1 or 1,000% of people that have a huge surplus of wealth that is just not, it's sitting on the balance sheet of a company, and the company is able to do stuff with it. Google's able to invest and grow into the behemoth that it is. So, yes, that's providing value to Google, but is that providing social benefit? And the argument is that this very, very, very small percentage of the population owes it to society, owes it to the rest of the population, that the trickle down hasn't been enough. Yes, it's been a little bit, but it hasn't been enough. And so we're going to tax this in order to provide the healthcare and the education and yada, yada, that society as a whole, we've gotten together and said, as a group, this is what we think is important. So that's part one. Let's come back to your other question. So your other question was, is that reasoning, or is Andrew's reasoning about why we should protect wealth legitimate? Is that right? Remind me.
No, the other thing was I kind of liked what Andrew mentioned in terms of reinvestment or redeployment of that capital. But you raised a good point. Like it's right now, it's on paper. It's a lot of paper wealth. But however, we got to think about what's driving the revenues is the businesses. But the
Yes.
businesses are driven by the leaders, the founders, the leaders, the individuals that hold a lot of this paper wealth. But these businesses can generate income, can generate growth potential by issuing shares. They can issue shares if they're publicly traded, and that money usually gets reinvested into growth. And the same with the borrowing. Like they can borrow, but I guess we have to maybe separate the business from the individual, or maybe we can't, because if you lose the individual, you lose the business.
So I think this is a really, really good point. So
yeah,
the other thing that's happening here is that they're dividing the individual from the business. So nobody is saying we want to get rid of Google, right? Nobody is saying like an Alphabet is the appropriate corporate name for Google now. But
yeah, we don't want to tax the businesses more.
California.
This is an individual personal income tax thing.
Well, and this is the other thing that I think most people would agree is if they said, hey, if we tax Google more, or any business for that matter, if we make it unequal, if we make it undesirable for a business to be in the state, then the business will leave. Tesla was a perfect example. They had all sorts of state and local government that were totally down their, back about all sorts of different stuff. And Elon even publicly calling him out on Twitter. And he was just like, okay, message received. And he moved his entire business to Texas. And there were a variety of reasons. Tax was probably not one of them. Maybe it was one of them, but it wasn't a major one. Anyways, I think one of the things that's happening here is that people are saying this is an individual rather than the business side of it. And they're sort of inextricably linked when you look at where the wealth is coming from. And if we say, okay, well, we're going to force these founders to liquidate their stock in these businesses in order to pay these individual taxes, it's also going to potentially weaken the structure of the business. So if the business, if Google essentially says, well, we can't, there's downward pressure on our stock, our value of our company is less, they're putting less money to work. Now, this is a subjective opinion. There's going to be people that say they have more than enough capital, they're high margin, monopolistic, yada, yada, yada. But the fact remains that I think generally as a population, we have to agree that business is good. Businesses provide jobs, right? We don't want to have fewer businesses. We don't want to have fewer jobs. So, Andrew, what do you think?
Yeah, I think if we're pushing a lot of these guys out, it will probably create an impact in terms of jobs and everything. Moving companies, they'll relocate their businesses. And listen, a lot of these guys, a lot of these individuals and companies, they have the capital to fight back, right? So to force someone to essentially pay a tax on unrealized gains, enforcing that, I think is going to be a long battle in court and everything like that, and it's just going to cost a ton of money. So the real revenue from this, from this move may not be that much, right? Like
the net gain, because they're going to suffer a loss on the other side. I think the opportunity is to have some kind of policy around the reinvestment of that wealth. So on the individuals. So if the individuals, maybe you give them a tax break if they redeploy that capital, maybe they get a tax break, or
being redeployed into the company. Like if they're not selling stocks of their company, that's essentially the same as reinvesting money back into the company, right? They're not pulling money out of that entity and essentially they're reinvesting that. Like they have a choice to pull it out or not. So keeping inside the company and growing it is a form of reinvesting.
Does it work the same if you're publicly traded and you're selling those on the market? On the stock market, isn't someone just taking over your position? Are you talking about selling that stock back to the company?
If it's coming out of treasury, it's new money.
Yeah, or you can sell it yourself. Like you say, I have personal tax, like shares in the company. I can decide to sell that on the market or to anybody, right? I can sell this share to anybody, but I decided to keep that inside the company, right? Now, essentially, when I hold shares, that makes the market, like there's less shares circulating on the market, keeping the value of the company high, right?
But if you're a shareholder, so if Sergey Brin sells his stock, that capital doesn't flow to Google, it flows to him. he would have to then reinvest it in Google. So Google would have to issue a bond or again, a share issuance from Treasury for that money to go back to the company.
Yes, you're right. But like what I'm trying to say is if you're selling shares on the open market, you're essentially increasing the amount of shares that are on the open market. So, you're essentially devaluing the value of those shares because now there's more liquidity on the market. Right.
Right.
So
You're diluting. Yeah.
yeah, you're diluting a bunch of individuals here. Now the share prices are going down. Essentially that is going to have an impact on the company, right? The company valuation is down. All of the essentially, shareholders are going to suffer because now, essentially their shares are worth less. The employees suffer. It's actually, it has a trickle effect. Like this is what happens, that everybody that works at these large conglomerates, they have a large amount of their wealth probably in their shares. Like a lot of NVIDIA employees probably have a significant amount of shares in NVIDIA. So if Jensen decide, hey, you know what, I'm going to sell off a bunch of shares on the market to pay off taxes, you know what that's going to do? It's going to drive down the price of NVIDIA, and it's going to drive down the level of wealth of all those individuals that are involved with NVIDIA. So it's a trickling effect. Like even though, yeah, sure, they're selling their shares, for them, it may not be that big of an impact, but it will have a trickle effect on the market. Because essentially you're creating liquidity on the market, especially for these large companies where they're worth in the trillions of dollars, essentially being at the Meg 7, right? Like, well, it has a very negative impact on pretty much employees. A lot of people actually, they'll have an impact on the S&P 500 because like this thing that they're
I think this is a topic you can argue till you're blue in the face. I think you can make arguments on both sides. I don't disagree with either side. Let's tie it back to Canada. Okay,
yeah,
maybe
so
one more.
Let me start with one stat and then we'll tie it back to Canada. So one thing that I found was interesting, you guys actually alluded to this, is how much is actually going to get raised from this? Like, is this going to work? And there are two major corollaries. So the examples that come to mind for me was Norway. I don't know if you guys have heard about this experiment in 2022, and then New Jersey, I think around the same time. So the Norway experiment, I just looked up some stats from Perplexity. So in 2022, they increased the top marginal tax rate from they increased the capital gains tax rate to 37.8. So the result was between 2022 and 2024, between 250 and 300 multimillionaire plus, so millionaires and billionaires, left the country, more than double previous years, including their top taxpayer. And it says that despite the exodus, the total revenue collected rose, but only marginally. So it went from 27 billion kroner in 2022 to 34 billion kroner in 2025. So essentially they're saying it was a very broad increase. So that doesn't just apply to billionaires, obviously. So that's across the whole public. But it was such a large hit that it essentially removed a lot of that top end tax.
It went from what to what, Kyle? It went from
27 billion to 34. So essentially
that's like 15-20%.
Yeah, 26% in 4 years.
That's pretty good.
Yeah, but the important part that I'm trying to draw is that was done across the entire tax base, and they lost a large portion of their top taxpayers, like the billionaire class. So you could argue that it did what it wanted to do, but they'll probably it'll probably have an impact in terms of the amount of reinvestment.
And it would have went up regardless. I'm sure it would have went up and just naturally on its own over 4 years.
The other example is New Jersey. So New Jersey did this in 2020 with the millionaire tax. Earnings over $1 million went from just under 9% to just under 11%, so roughly 2%. And although it was they did collect higher revenue, additional higher revenue from high earners over the longer period. So 2013 to 2022, New Jersey lost about 170 billion in residential income, in resident-based income, and it contributed to a roughly 5 billion income loss between 2021 and 2022 alone. So what that was doing is that was specific to the high income tax bracket, and clearly a lot of people left the state. There were hedge funds and stuff like that left, and it had a direct impact on the deficit actually increased because the revenues were down. So they actually had to borrow more after having to generate that income. So my prediction is if it passes, first of all, there's going to be a huge exodus. And I agree that the litigation and piece like that, but if it actually goes through, they're going to have such a significant exodus, and they're probably going to have a significant exodus even if it doesn't go through based on what we've read. The number of people that are leaving, they're going to have this, what Friedberg was referring to, which is this massive hole in the operating budget. Now, let's tie it back to Canada. So Canada's, like you alluded to earlier, it's also running a massive
what blows me away is
deficit.
it seems like all these countries and states that have these unfavorable they're unfavorable tax jurisdictions where taxes are high. It seems like they're the ones that have the greatest deficits. I think, why is that? Like, that's why I'd like to look at, I like that you reference you cross-referenced, Norway and New Jersey. It'd be interesting to look at states like Florida and Texas, where those states are very low on state tax for income and for a number of other tax generating avenues. But how are they doing? Like, how do those states and or countries stay positive when they're not generating the tax base? Is it the expenditure, social services are down? Are they generating revenue in other areas? Like what's going on?
Broadly speaking,
look at Canada.
The only way that you can not charge a bunch in tax is if you don't have a bunch in outgoings, in expenses. And so the main criticism from people in California has been, and you alluded to this as well when we started, which was like, this isn't the way to balance the books. The best way to balance the books is you really, as a household, if your bills are coming due on a month-to-month basis and you are spending more than you're making, you have two options. You can spend less or you can make more. And so California is taking the position that they need to make more. Whereas other states, especially low tax jurisdictions, essentially have said, we cannot support public spending because we don't charge it enough in tax. Now, they have the choice. They could say, this is a perfect example for Canada. This is the corollary I was going to draw. In Canada, we have a range of provinces, and those provinces there's a federal tax bracket and then there's a provincial tax bracket, much like the states. Now, the states kind of has a strange thing where you can actually, it's called SALT, state and local tax deductions. You can actually deduct from your federal obligations the amount of tax you've paid at a state level. So if you pay a lot of tax in California and New York, there are ways that you can deduct or reduce your federal tax bill because you've paid more as a state. We don't have that in Canada. But what we do have in Canada is we have a varied provincial tax base. And there are provinces like Quebec that have much higher spending, and BC as well, much higher public service, public spending in proportion to income. And so they have a higher tax base. In the reverse of that is Alberta, or arguably for the last 20 years, where they have maintained a very low provincial tax and a very low consumption tax in the form of GST. So we don't have a provincial sales tax, unlike other provinces, flat 5% GST which is federal. So I should say we don't have a provincial tax. We only apply the federal tax. And as a result, we collect less revenue from those taxes. Now, people have always argued we should add taxes, we should pay more in tax, charge people more in consumption tax, because we want more money to spend on public services. The Albertan, more conservative viewpoint is we don't want those services. We don't want bloated government. We don't want a bunch of, programs, special interest, all that kind of stuff. We would rather, to Andrew's point, you leave the money in our pocket and we will distribute it how best we see fit. We will build the economy that suits us. And so the province is limited because, again, it has two choices: either spend less and tax less, or spend more and tax more. And I think that's a lot of people, again, I think we all know it in principle, but I think the real thing that's coming down the pike for Canada is there is going to be, because of demographics and because of all the things that are changing in the economy, there's going to be a lot less tax collected. So we have two choices. We can either spend less on programs, on social services like pharmaceutical, all these new sources of funds, and essentially tax more to maintain or increase the amount of social spending, or we have to cut spending. We have to cut the amount of money that our expenses every month and hope to balance the books if we have any chance of digging out of our debt and maintaining or lowering our tax base. So anyways,
think
that's the
cutting spending is
transition.
always the harder thing, as we all know. It's easy to say, hey, let's create some revenue by putting on additional tax, but the hard part is cutting the fat. Yeah, think about it. It's just like having fat on your body. It's not easy to lose that fat. It's easier to fuel the machine, fuel the system with chocolate bars or doing other things. But if you got to lose that fat, it's very difficult. It's onerous. And I think that's what we're experiencing. And it goes back to Andrew's point earlier, that is that money better suited in the taxpayer's pocket or the government's? And unfortunately, what we've seen historically here is we've seen a bloated government, we've seen overspending, so that doesn't give us the confidence that we want to put that money with the government. We can deploy that money more responsibly and generate more return, more value on that money than the government can. And that's been proven here for over decades.
So the other thing, that interesting point just on that, which we as a country uniquely suffer from, is the spending that we are doing isn't actually investment spending. So I think we would all actually change our tune if the government said, hey, we're going to take all of those federal dollars that we're generating, all the revenue, and we're going to invest it into innovation, into technology, into R&D, into things that have the potential to actually generate a return on that investment. The problem that we've had as a country is not only is the private sector not doing that, the public sector isn't either. So the public sector has been spending money like a drunken sailor, driving up asset prices, all that kind of stuff with the housing market. And it's not actually leading to growth. It's not actually going to pay dividends. And so when inevitably the country goes through another recession or a downturn, we're already, our lines of credit, our loans are already going to be maxed out because we've been running crazy deficits during normal or boom times. And so it's just going to be catastrophic. Like the math doesn't math after that point.
Mm-hmm, mm-hmm. Yeah. So just to answer
On that note, Andrew.
to answer your question, Mike, there are countries like Singapore and Dubai that really prosper, I guess, without any kind of high income taxes or any kind of taxes at all. And that's because they kind of replace the like tax extraction with like ownership, essentially ownership, right? Like the way they kind of structure their government is like, they have ownership fees. They position themselves well in the market. So they act like well-oiled, well-run holding companies that happen to be governments, right?
Fund managers, they're like managing a portfolio. Right?
Exactly. So they kind of, they capitalize on the growth of their own market, right? And usually some of these countries are situated in very critical, like points, like choke points, for example. Like there is a port for all of Asia or port for all of the Middle East. So they really capitalize on that. And because of their size, they can push policy and adapt policy really fast. So most of these countries tax because like most countries, they tax because they have no other ways to monetize the growth. And meanwhile, those countries that have very low to no taxes, they have a avenue for growth, right? They don't need tax. They don't need to extract taxes from individuals. Like some of the northern European countries, they have very large sovereign wealth funds that essentially are investing and making a crazy return. They don't need to be focused on tax extractions, right? So a lot of the time, some of these, and then once they have these engines going, they will start to make promises. Like we will start to pay for certain things. We'll start paying for, some kind of benefit for our people, right? But they don't run that. They don't say, hey, you know what? We're going to give you everybody this benefit that's going to cost the government billions of dollars, and then tax the people to pay for it, to fund it. So they have ways to do it. So it's almost like they're just spending without really thinking about it. So going back to what I said earlier, the government is like a poorly run business in some of these countries, whereas the more successful countries, they operate like a well operating holding companies, right? So that's essentially why they don't have to tax so much.
Yeah, it's true. We sold off the 407, which was a revenue generating machine, to a private company. That's an example. But you're right. There's countries that have ports. The taxes they gain, the revenues they gain from those ports of entry, from resources. Like Dubai and Saudi with the oil. I think we have to look at our fiscal policy, and we have to figure out, one, where can we cut spending? I think we can all agree on there. Where's the bloat? Let's trim down the machine so we can run leaner, we can run stronger. And the other thing is, I agree. The other side, at the beginning of this podcast, we talked about it. How do we get to profitability, up revenue, or reduce expenses? So I think the deficit's so large that you have to tackle it from both ends, and it's got to be a two-pronged approach. Start with expenses, lean up, do it like Alberta. Take a page from Alberta's book, and then take a page from some of these other nations and countries that have these sovereign wealth funds that are capitalizing on their assets, their resources, their infrastructure, and they have these investments where they're generating income for the state, for the country, for the province.
Yeah.
That's what I think.
No, you're right.
Easier said than done, obviously, but
Basically, we need better money managers inside the government. We need people that knows, if they're going to spend one tax dollar that's in the bank, how am I going to bring back, 2 or 3 tax dollars? How am I going to make money on this, right? We don't have that kind of thinking right now. We just have this thinking where, up the taxes, that's going to up our revenue, and we can spend more. That's essentially the kind of thinking that we're getting.
It's nearsighted. It's nearsighted. So Andrew, you're going to run for some kind of position? Can we elect you in? You have my vote.
This is actually like part of the problem, is that people don't want the job. And even if you had the job, how are you going to get 50% or more of the population to vote against a smaller share of the wallet? Like, this is where the whole socialism conversation comes in, because younger generations are coming in and they're like, we've got nothing, you've got everything, so why don't we take what you've got, right? Like, there's no risk to us.
Well, this comes back to really Doge. Easy. Whatever happened to Doge, the department, in the U.S.?
Well, the waste, fraud, and abuse is still there. And I think that the problem is that they ran up against that political wall, right? Like Elon talked about it months and months ago, which was essentially there is a lot of grift in government, and it's based on the spending. And you're seeing, anecdotal evidence about that of that in states like Minnesota with this daycare fraud, where the state was receiving money, federal tax dollars and state tax dollars. They were granting or giving that money to operators or communities with operations in them for a bunch of different, high virtue reasons, none of which were tied to like economic activity per se. Lots of social programming. Anyways, and so it turns out that those groups would turn around and donate tens, if not hundreds of millions of dollars to the same benefactors that were the ones that were legislating it. And so it's not hard to see that if there's enough, money changing hands in this sort of roundabout way, those politicians are never going to want to get rid of the funding bills or the spending at the government level, because they're beneficiaries downstream of it. And I would argue we have the same problem in Canada across both state or provincial and federal government. Like, there's just so much grift. We haven't even talked about the First Nations industrial complex. Like, that's a whole other issue, but it's symptomatic of the rest of the country. So anyways, we're getting a little off topic. Why don't we put a pin in this for now? Another thing we should talk about, we'll talk about it in another episode, is what options do we have as business owners if this starts to rear its ugly head in Canada, where, fiscally or otherwise, a provincial or a federal government says, hey guys, this is desirable. We're going to go after, value creators. We're going to go after assets. What sort of options do Canadians have if that means going to another jurisdiction or whatnot? So we'll talk about that. Any final comments or anything that we want to end with?
No, but I think the next podcast we should definitely explore that topic you mentioned. I think we could do some research. We could circle back and we could look into that. It's something that's constantly coming up. We see a lot of our peers opening up in different provinces, different states, different countries. I think maybe we can do a seminar on that. I do have a group that has businesses. I'm part of a group that has businesses in the U.S. And right now, apparently their businesses aren't doing great. I guess for various reasons, their U.S. businesses aren't doing great. But I would like to find out more about that, and then we could circle back on this podcast. They don't seem too concerned. They're saying it's just cyclical and it'll come back. But I'd like to know a little bit more why those businesses aren't prospering. These are Canadians that have started businesses in the U.S.
Awesome. Sounds good. All right. We'll get to that one on the next one. Thanks for joining us, and we'll talk to you then. Thanks.